Every year, companies spend billions of dollars carefully selecting, interviewing, reference checking, and onboarding the wrong people. Roughly half of all senior executive hires fail within 18 months. Half, which means every key leadership hire is statistically flipping a coin. I'm going to show you why that coin flip is probably the most expensive fuck-up that happens in the business. And what can you do about it? Most owners, when they think about the cost of a bad hire, think about the salary, maybe the recruiter fee. They are off by a factor of 10 to few thousand. Here are the actual numbers. The industry data first, then a number that will make Starbucks shareholders feel seen, then a real company, 30 million in revenue, fashion business, 2 bad hires, 1 very expensive season. And then what to do about it? How often does a senior executive hire actually fail? Depending on the function and the source, between 38 and 50% fail within the first 18 months. These are not outlier numbers, these are the averages. 48% of senior executives leave, fail, or are pushed out within 18 months. 50% of externally hired C-suite executives fail within 18 months. 42% of CMO hires are considered unsuccessful within 18 months. 38% of newly hired executives fail within their first 18 months. So, roughly half on average across functions. How many were not reported in these numbers and they just stay and continue to be inefficient? Nobody knows. You would not board a plane with 38 to 50% failure rate, don't you? You would not take a medication with a 50% failure rate, but for senior hiring, that number is industry standard and nobody discusses it before signing the offer letter. Now the cost. The number you usually hear is 30% of annual salary in direct losses. This is the US Department of Labor figure. It is also the most optimistic number in the room. Here is what a proper calculation looks like. Direct costs. Recruiter fee up to 50% of annual salary, salary and bonuses during the failure tenure, typically 12 to 18 months, time of everyone involved in hiring, onboarding, and managing the fallout, severance. Then indirect costs, decisions not made, initiatives delayed or cancelled, team members who left because of the wrong leader, clients lost, deals that never closed, budget burned on the wrong strategy. And the third is strategic cost. What the company could have built during these 18 months with the right person in the seat. That doesn't appear on any spreadsheet. And it is often the largest number of the three. Add it up properly, not just expenses, but the full economic impact. And the numbers become uncomfortable very fast. $5.4 million is a true cost of a failed 200 grand executive hire. This is 27 times the annual salary. According to their research, 2 to 5 million is an average direct loss from a bad senior hire per a study of 150 chief HR officers. And the most interesting part, estimated cost of a failed CEO by company size, $13 million for the small company, 22 million for the mid-market, and 53 for the large company. And before you say this is for big companies, not for me, we will come back to that. Let us look at a case everyone knows. Starbucks, 4 CEOs in 5 years. The direct cost of that sequence was 21.5 million exit package for the departing CEO in 2024, 95.8 million compensation for the incoming one, 60 million severance in 2022 for the same one. Total visible executive turnover cost across 5 years, approximately $177 million. This is the part that appears in the SEC filings. What does not appear? 4 years of strategic incoherence, brand erosion, falling same-store sales, employee morale at historic lows, market capitalization down by billions of dollars, and competitors gaining ground that Starbucks has not recovered. Nobody has calculated the full cost of those decisions because you cannot, because it is simply not recoverable. Okay, Starbucks is a $100 billion company. They survive. Most companies do not have that cushion. Which brings me to a $30 million fashion business and two hires. A couple came to me through a referral. They had built a fashion company from 0 to 30 million in revenue over 10 years. They got goods from their own production, partner factories, and imports from China and Indonesia. 150 people. Real business built on genuine commercial talent of the founders. They had made two bad hires at the top, a chief commercial officer and a finance director. The CCO was an excellent salesperson of himself. Under his watch, sales barely grew for the first time in 10 years. The autumn season, which normally funds the entire following year's production, produced almost no profit. Inventory sat on the warehouse. In fashion, inventory that sits one season comes back marked down. Inventory that sits two seasons gets written off very often. The warehouse was full of next year's problem. And the finance director was in practice a bookkeeper. She didn't understand the difference between management accounting and tax accounting. She was allocating all fixed overheads, rent, salaries, loan interest, across own production volume, which made the in-house factory look very expensive relative to contract manufacturing. The correct calculation was totally different. Incremental cost is not what it costs to produce X units, but what it costs to produce one more unit right now. Strip out the fixed costs that exist regardless of production volume, and the in-house factory was 30% cheaper than outsourcing. The right decision was to run it at full capacity and expand it, while they were going to actually close it. Wrong numbers, wrong decisions, systematically for years. They also had constant cash flow gaps, expensive overdrafts, delayed supplier payments, straight credit lines, partly because nobody was running cash flow planning, partly because the client documentation process was broken. Clients were paying late simply because the paperwork was wrong. Pure operational failure. Nobody had looked at it. I came in as a fractional CEO. 4 hours per week in average, a retainer at about 40% of what a full-time CEO costs for the company that size. We agreed on a 6-month horizon with a bonus on results, and I was done in 4 months. So what changed? In finance, new financial director right from the start. Proper management accounting, production decisions flipped immediately. Factory ran at full capacity, cash flow gaps disappeared, and the bank financing costs dropped significantly. Magic! Second, commercial. I started by myself, and the sales pipeline reviews with actual visibility, rebuilt channel rules and payment terms. Then I brought in new fractional sales director, and the previous CCO left voluntarily, which saved everyone the severance conversations. Number 3, production. We implemented the flow line manufacturing. Output per person more than doubled in just a couple of weeks. Then we started to implement 5S and very basic quality systems. Defect rates dropped sharply, like tens of percent. Material waste down over 15%. Unit cost of production down 17%. We could increase wages because that was a problem. It was a big flow of people. So that reduced turnover, and that again improved quality even further. And number 4, CEO function. The main thing I did there is educated the founder to do the job properly. So we hired 2 new senior executives who actually fit the roles. We built the operating model. It's planning cadence, delegation framework, management meetings, the business health dashboard, and the following season was the best in the company's 10-year history. Talking about the numbers, for a few years they did between $1 and $2 million per year. The year I came in, it was slight negative. Can you imagine that? And the next year it was plus $7 million. A year after next, already without me, it was plus $10 million. So if they would have invited me 1 year earlier, they wouldn't have that slight negative, okay, that was 0 minus year. They would have this 7 million immediately. Then the next year they would have 10, and year after next, I don't know. Okay, let it be another 10. So it's $27 million. And we do remember the numbers of 22 for the small companies. You see, the numbers fit pretty close. And for me, it was 4 hours per week in average within 4 months. Of course, the first couple of weeks, it was huge. It was not 4 hours. It was maybe 5 hours every day. But after that, it was nearly nothing. It was like half hour, 1 hour per week, not more than that. So 4 months. The rest was knowing what to look at and having done it before in larger and more complex organizations. That is the fractional model. Cheaper for the employer, more money for the employee, better for everyone. If you are a senior executive watching this, CFO, CMO, COO, CRO, CHRO, senior VP, maybe senior director, or even CEO, and the case I just described is exactly the kind of work you know how to do, here is the problem most people in your position face. The expertise is real. The market for it is growing. Fractional executive demand is up 68% year on year. The global market is $9.4 billion and projected to reach $25 billion by 2034. The gap is not your capability. The gap is the system to convert that capability into clients, contracts, and income. I built that system, and you can too. Watch the steps to your practice. It is called the Fractional CXO Blueprint. 7 blocks, each solving a specific part of the problem. Block number 1, self-analysis. Who is your best client? Not who you have worked for, but where you have genuinely won. The industry, company size and stage, the specific pain you solve, this determines the quality of every step that follows. Block number 2, offer design. Companies do not buy hours, they buy outcomes. You build a specific scoped offer with a concrete deliverable. Not fractional CFO service, but something like a 90-day financial clarity program with a board-ready KPI dashboard and a cash flow model that answers the questions your investors are currently asking. Objections addressed before they are even raised. Number 3. Pipeline that runs without you. LinkedIn content that shows how you think. Not credentials, not inspiration. Strategic referrals from 20 specific people. Fractional platforms for early credibility. Targeted outreach that leads with the situation, not your resume. A system, not a series of accidents. Block number 4, consultative selling. Most senior executives are so uncomfortable with sales because they have only seen it done very badly, either aggressively or desperately. Consultative selling is diagnosis, not persuasion. You understand the problem deeply, you determine whether your solution fits, and if it doesn't, you say no. That posture, combined with genuine expertise, is what converts. You cannot develop this from books alone. We do assisted practice. Block number 5, delivery and renewal. Fractional work is different from a full-time role in many aspects. So, making impact visible, baseline metrics before you start, weekly tracking, monthly impact reports, not status updates, impact statements. Expanding naturally. Once a company trusts you on one problem, the next problem becomes a conversation. A 3-month contract becomes 3 years with project fees layered on top. Block number 6, execute, not consult. Consultants deliver reports. Executives own outcomes. Nobody wants one more PowerPoint slide deck. You show up as a member of the leadership team. You initiate and attend the meetings that matter. You make decisions not recommendations, and you raise problems and own the solutions. The client feels the difference immediately, and it's a complete delivery framework available for you that you might not have mastered during your full-time career. And the block number 7 is to scale to a firm. Most fractional executives stop at 2 to 5 clients. That is very okay. And that is a practice with a ceiling of your time. But the next level is documented playbooks, repeatable delivery frameworks, practitioners who execute under your methodology. Your clients stop buying your expertise and start buying an entire function, including maybe content, reporting, and execution, as a fraction of what building it in-house would cost, with better results. Can you do this all by yourself? Sure, you can. You are a senior executive. You surely can. It took me 8 years plus previous 20 years of corporate setting experience to get the system up and running. You can take this journey with me and land your first clients in 12 weeks. To be clear, I do not guarantee that you will get these clients. If you need that kind of guarantee, you are not ready for your fractional career yet. What I do guarantee is that you will get a working method, and I guarantee a 1-month unconditional money back if you are not satisfied with the way we go. The logic of this program is this: find the clients who need what you do most specifically, so they see value fast, they renew, and they deepen the engagement. Sell to them the way that feels honest and works. Deliver like an executive so they genuinely get the outcomes they hired you for. And structure the whole thing so it compounds over time rather than starting from scratch with every new client. For clients, this means something specific. They end up working with exactly the right person for their situation, not someone who sold themselves well and hopes to figure it out, with full transparency of what is being done and why, and real accountability for results. The contract structure makes that unavoidable. The entry point is the Fractional Revenue Calculator, a tool that shows you with your actual numbers what a fractional practice looks like financially at current market rates. Do this even if you are fully employed right now, especially if you are. The link is in the description for this video and in the bio. If you are a business owner and the case I described today looked familiar in ways you would rather not admit, let us talk. Not a sales call, a diagnostic conversation. I look at your leadership team, your current situation, and I tell you what I see. And you decide what to do with it. Sometimes the answer is a fractional engagement, and I might suggest some candidates. Sometimes it is something else entirely. Either way, the conversation costs you an hour and tells you something useful. The link for that is also in the description, separate from the calculator. Bad hires are extremely expensive. They're also fixable, usually faster than people think. This is the video. See you in the next video. Don't forget to subscribe and like this one if you really like it.